Hey guys, welcome back to the Avoiding Broke podcast with me, Jamain. Unfortunately, Leanne couldn't join us today, but I want to make sure I try and do a great job in her absence. And so guys, today I just want to cover a Q4 update on some of the key trends coming through the investment landscape and what it really means for us as investors in terms of where we can go and try and extract a little bit more value for ourselves. So just thinking about the kind of stock market first. You know, we saw some really interesting trends where just a short while ago, stock markets took a dip. They seem to have rebounded. A lot of really big blue chip stocks seem to be performing well. And it sounds in many respects like there's a lot more confidence in the stock market. So on the one hand, that's fantastic. And frankly, if you left your money in and if you're in a tracker fund, you're probably going to be looking at fairly reasonable returns even post this dip. So I think, guys, it's tempting to look and think, this is a great thing, and to maybe stay in and hold. You know, my gut feel on this one is we need to still be a little bit more cautious. I mean, look, let's not ever forget that in the macroeconomy, they're still printing far more money than these countries actually produce in economic output. So is it possible that we are looking at some overheated markets? Is it possible that there is just too much fake money kind of flowing through? And actually the buoyancy that we see in the stock market is maybe a little bit inflated, maybe a little bit of false hope, maybe something that we should be cautious on. Look, guys, you know, my outlook is yes, to an extent. So I've got far less exposure to stock markets that I think could be overheated. Up to you where you want to go with it, but just want to share that thought. You know, so then when we think about kind of bonds and we might try and think about fixed interest products, you know, what does it really look like? How attractive are they really? Oh, you know, I think it's a really tough one because in a low interest rate environment, actually the return that you're getting on some of these fixed interest products is actually fairly low. And you still have exposure and you, in some respects, don't have the same level of liquidity. I think it's tempting to look and think, actually, it may not be that attractive to jump into products that may tie you down for a while. Particularly not if you're not getting a great return. So to a large extent, we need to kind of keep a little bit of flexibility and remember that having flexibility and a lower rate is sometimes better than having a slightly higher rate of return, but actually lacking flexibility altogether. So just one that I'd encourage you to kind of really keep your mind on and really be smart about. So another really big popular theme that we think about and talk about quite a lot is real estate. So where are we going with real estate? Where are we going with property? Now, for a long time, you know, I've had a hunch that the property market has not been in great shape. There's been some question marks around the quality of demand that we've been seeing in the market. So, you know, can people really afford the products, the properties that they're really looking for? You know, in an environment where a lot of businesses are failing, can you genuinely afford to take on those bigger mortgages? Do you know, because your job security, in theory, is reduced, and that's across the board. Well, what we've seen recently is actually some of the demand in the housing market really tailing off. So this is incredibly important, right? Because I think if you're looking to speculate as an investor, this is when you may start seeing some better opportunities. Because as soon as demand tails off, you go into this a region where you've got increased supply in the market, right? And you've got fewer people buying. That can give brilliant opportunities because you might see price reductions, you may see more motivated sellers, and your ability to negotiate a better deal, it could be increased. So really pay attention to that, guys. You know, the tail off in demand at a macro level in the property market could be giving us all some amazing opportunities. So cryptocurrency is another really big asset class that you see more and more interest in, and you're starting to read about it more and more in the press. And so guys, this is a fascinating opportunity for us with crypto because we've already seen like the big established cryptocurrencies, particularly things like Bitcoin and Ethereum that people know a lot about, make huge gains. I mean, even just this year, if you look back into kind of March kind of time, I think it was, you know, you really saw cryptos trading at a much lower price than they are today. And if you look at where the outlook is for them, it's actually really quite positive generally, particularly, as I say, amongst those big established cryptos. The way you approach them and the way you think about them is probably differing quite a lot for different investors. Because some will look and say, if indeed something like Bitcoin could realistically achieve, let's just say, for example, $100,000 value per coin in the next couple of years, then it looks like it's really undervalued at the minute, and so it becomes a great tool for trying to capture some upside. Others will look and think that crypto is giving a really great alternative to traditional commodities like gold, silver. So then at that point, you're thinking less about how much upside you can capture, but more about the ability of the coin to be a very good hedge product for you. Guys, whatever your view on this is, let's make sure we don't sleep on the opportunity of crypto. Because no matter what, we're still seeing this asset class emerge, which is looking like it's becoming a credible store of value. It's getting more and more recognition from big institutions and from governments. And once you kind of get mass adoption, you then start to see the potential to realize greater value. And I know that there are a lot in the community who think that things like Bitcoin are massively undervalued. And there are a host of other coins that are coming through that people think could genuinely start to challenge and replace some of our traditional financial system. Really important, guys, because even if you don't want to get involved now in terms of your investing, you should still have awareness, because you've got to keep your mind educated and updated on where the emergent stores of value really are. I think crypto could be huge. It's a personal view. Very much do your research and leave a comment if you've got any questions, and I can share with you some of the things that we're reading and listening to. Another fantastic asset class, obviously, to look at are your commodities. So particularly for us, we're thinking about gold and silver. Guys, historically, gold and silver just provide a fantastic hedge to particularly things like stock market exposure. And I don't think an awful lot has really changed. I mean, you've seen a little bit of price fluctuation within relatively tight bands. And I think we still need to make sure we've got a portion of our portfolios committed to these commodities that have always got a very reliable and predictable spot value anywhere you go in the world. So I love having a bit of gold and silver, and that's not going to change anytime soon. Now, one question that we also get is around cash. And, you've got cash is trash in some beliefs, and others believe cash is king. I think for me right now, I still remain somewhere in the middle about the long-term value of cash. Look, I just think that obviously if people print money faster than you can earn it, and if inflation means that if you hold cash, it decreases in value every year, then of course the value of it is long-term negative. I've got no doubt about that at all. But what we are seeing right now is a more short-term value of cash that we shouldn't really sleep on. I think particularly where you don't necessarily have as much long-term confidence in a lot of different asset classes, holding cash just is a very safe move for a short period of time. And I think if you see something that you decide you can later jump on, having cash, obviously you're the most liquid you can be, having cash just lets you jump into it very quickly. I think it's a really, really great thing to be doing, actually. Bigger cash stores waiting for a move. But I think you can't necessarily afford to wait too long. Because we still even have, for example, our currency risk, right? So currently in Britain, we're undergoing our Brexit transition. And so you could very, very, very easily see big devaluations in the value of the pound. So even then, against particularly things like the euro or the dollar. So even then, you've got to be thinking, if you're holding your money in pounds, you don't want to wake up one night and all of a sudden see that you've gone and lost 10, 15, 20% of the value of your currency relative to something else. So that currency risk is really important right now. I mean, you see it with the pound, with Brexit. You've seen some discussions about the US dollar potentially losing its reserve currency status, maybe a little bit further off, but we never really know. So I think you've just got to be really alert to currency risk if you're choosing to hold in physical currency. To be honest, I'm really not too sure I stand on it. I think you've got to have in your local denomination some buffer, some emergency funds. But I think the prospect of currencies holding physical cash, it probably gets less and less attractive for me as the weeks go on. But still one that I think you can't really avoid having to have that cash pot. So there you have it, guys. Look, that's the take from me on the short-term investing outlook. I mean, you can see, right, there's a lot of variance happening in markets. There's a lot of movement happening in the macroeconomy. I mean, look, crazy that we still haven't seen a validated and fully confirmed US presidential election outcome. And we know that in the UK, for Britain, we're still trying to negotiate the terms of our Brexit deal. So you can see how much movement there really is, guys. And so for us as investors, we've got to be very versatile, and we've got to be very able to kind of pick up on these macro factors, build them into our decision making, and put ourselves in the strongest, most resilient position we can be in. So guys, if you've liked what you've heard, and if you've got any questions or comments, please leave them below. If you've taken value from the video, please smash the like button, because it helps the channel massively. And if you're new to the channel, please consider subscribing, guys, because we're trying to, on a very regular, real-time basis, bring you value to help you make better financial decisions. And the more likes we get and the more subscribes and comments, is the more we get a sense of whether or not we're indeed bringing you what you need, and all feedback helps us improve the content on the channel massively as well. So, as ever, guys, hope you're enjoying your Christmas celebrations. You see I'm Christmas jumping up, and I've got a couple of trees around the house. I think next week is probably going to be our last video before we shut down and take a little bit of a break for Christmas. You should have at least 2 of us. Maybe we'll even bring Theo on for a little cameo as well. But until then, guys, look after yourselves. Drop a comment if you've got any questions that you want to follow up on. And I'm really looking forward to absolutely smashing next week with you as well, and having a great end to 2020. All right, guys, till then, take care. Bye-bye.